Good evening and welcome to Your Money, Your Call. I'm Chris Gray. On tonight's property edition of Your Money, Your Call, what's happening to our property market around Australia? Some areas are flat, others are falling, and some are even rising. Where's the best place for you to be right now, and what's the outlook for the future? Also on tonight's show, making investment decisions based on tax deductibility. Should it be the first thing to consider, or perhaps the last? With many people starting to prepare their annual tax returns, what expenses can you include and what will get you in trouble with the ATO? Now joining us on our panel of experts tonight is Dr. Vito Mollica of Rismark International and Shukri Barbara of Property Tax Specialists. So if you've got a question about what's happening to our property markets around Australia or anything to do with accounting and tax for properties, then please give us a call on 1300 30 34 35, or if you prefer, send us an email to property@skynews.com.au. Welcome to the show and welcome to you. Shukri, we'll start off with you. From an accounting sense, how are you seeing the property market at the moment?
Chris, at the moment it's soft. From the clients that are doing, they've all been sitting on their hands. They've been very happy with the cash flow. Everybody's been pushing their rents up. And so in terms of cash, they've been doing very well because rents are going up, but at the same time, interest rates have been fairly stable.
And I think you describe it very well, saying people are sitting on the fence. They're just not willing to make any decisions.
They don't want to make any decisions. They are very uncertain. There's a lot of things going on. Also, the banks are being tight with releasing money. And so if you've already got a few properties, it's hard for the clients to go out and get some more and revaluations. Because the market's a little soft, getting that additional value out of the existing property so that you can get some more money is a bit hard.
And what do you think are the main factors that will push people either over the fence on the good side or put them over the bad side?
Chris, for the clients that I do work for, a lot of them have a journey to go with property, and so to them it's a great time to find the right type of properties. There's a number of segments, as you know, in the market, and they are looking for where the opportunity is to get that bargain at this point.
And that's the thing, because if you look at things purely mathematically, which us accountants like to do and take the emotion out of things, it's almost a no-brainer that if prices have softened, it's a great time to buy.
Right.
But from an emotional perspective, it's the worst thing to do because you're out there on your own and the market and the media is not following you.
That's right. Now, a lot of the clients have had experience, and they know that when the market goes soft, it's their opportunities because the market will rebound and the fundamentals are strong. The rents are going up and there isn't enough supply. And so it's an opportunity for them to advance.
Yep. Now, Vito, you've been on the show quite a few times. Welcome back. Do you want to explain to the viewers that may not have seen you before exactly what you do at Rismark?
Sure. Well, at Rismark, I'm involved in the research team, and part of my job is actually creating tools to track the performance of residential property around Australia and also to value properties around Australia. We currently value every property in Australia every week. Which is
quite a mean task.
Yes, there's over 8 million properties in Australia, so it's not an easy job.
So how are you seeing the market at the moment?
I'd have to agree. It is not going up, that's for sure. We actually released our numbers today. In 2011, we've had over 150,000 sales, and prices are down for the June month about 0.2% in seasonally adjusted terms, or 0.6% in raw terms. So we've had 6 months now consecutive falls, but the rate of decline is actually moderating. Our biggest fall so far this year was in January, where prices fell 1.2%.
Yeah. Now, obviously, a lot of the companies that are selling shares or pro the stock market, they love saying, oh, the market's kind of dropping and it's pretty bad. In reality, how bad are those numbers?
Well, the interesting thing with property is we track, these indices measure average performance, right? So you're going to have some people that are going to perform better than it and people those that are going to perform worse. So we just try and reach a middle ground where people are going to say, okay, I think the property is good or bad. I think the consensus around the market right now is that it is weak, but I can definitely highlight some areas to you where property prices have been going up, likes of Newcastle or Gladstone in Queensland.
Yeah, and Shukri, I mean, Vito's saying obviously that some properties are going up, some aren't. I guess it really depends how well you planned in the first place as to what kind of properties you bought in the first place, as to if you're more likely to be in one of those volatile markets, isn't it?
Absolutely. Where you've got the two extremes. You've got Either you're holding property for the long term with growth as your objective, or cash flow properties, which will give you a lot of cash, but they may move very quickly or very hard in terms of value. Now, some of my clients have a balance of both. To work it out so that they can maintain a reasonable cash flow. You need cash just to maintain the growth properties anyway, and so if you don't have some sort of balance, it won't. But if you do have a strategy, that's the key. If you've got a strategy and you follow it, some of the clients who follow an exact strategy always advance faster than the others.
Now, Vito, you're talking about these, some are doing well, some aren't doing so well. How much can, I guess, emotions actually affect the property market? Because not everyone's looking at things like an accountant in black and white. There is emotional there. How much will that change the market effectively? Consumer
confidence obviously does impact property prices, but I do believe that it is a short-term, has a short-term impact. The reason, well, there's several reasons for that. Consumer sentiment is actually very hard to measure, and it is extremely volatile. It doesn't track very well with property price performance in the long run, we've found. But in the short term, it can have some benefit or indicators. I think the better measures of confidence in a market in the short term are looking at things like how many sales are there, how long are properties staying on the market, how much are people discounting their properties from their expectations.
And if the emotions can change the property market, say just in the short term and not in the long term, how much can the media then influence that emotion? Because, as you say, if there's a dozen properties that have made some money and there's a dozen that haven't, it's very easy for the media to choose, well, do we want stories on positive, or do we want negative, or do we give a balance?
Well, the media is definitely making it difficult for those that are investing in property, because they will hesitate. But I think you should rely on the numbers. Sure, there is an extent of emotion, but that emotion really affects how much extra you're going to pay or how much extra you don't want to pay. And in the end, there is a fair market value, and the seller of a property typically will tell you that, or knows the value of their home. So buyers have to come to an agreement, and I think, you know, dealing with real estate agents, you can get a better gauge as to what emotion there is in the market.
Now, Shukri, obviously people need to learn to analyse a lot of these numbers, and one way to do it is obviously shows like this. Another way is obviously the property seminars. When I started at 22, there's no seminars, there's no books. Now there's a whole plethora of them. There's all the TV shows as well. Yeah. With the seminars, do you believe that is a good way to get educated? And the second part of the question is, they don't always have a good reputation, so how do you find the get-rich ones that are kind of trying to make you millions overnight versus the ones that are much more of a university feel almost, that you are actually getting properly educated on what you need to know?
Chris, they're in the market out there, and there is a range of these offerings, and I get to see them because I get to do some tax returns for people, and they come ask for deductions when they take these things on. Now, from the range, it's always, firstly, it depends what part of the journey you're on. If you're just starting out, you need some basics, and you need to go and find out. And they're a good source to find out from there. But don't just go blind and be stupid. You know, the problems have been in the past where some of these people are cross-selling property to them, but not only just general property, property that they had an interest in. That's where the problems arise. However, most of the ones that I'm aware of do give quite good service, because I presented some of these things, and I sit there at the back waiting for my turn, and I listen to what they're being told. It's quite informative, but it's up to the individual to educate themselves. The alternative is, of course, to leverage against the professionals, people like the buyer's agents or the tax professionals and so forth, in order to shorten the time. The whole concept is, how quickly can you learn? And nothing will take away from the experience, and experience comes with actually doing the job, practicing a number of times and having a go. But if somebody can tell you to be aware and cautious on a number of issues that they've had problems with, that certainly minimises the problems.
And so it's certainly interesting to say that you can go direct to the professionals, and obviously you then pay an hourly charge to learn from that. And so I guess the hard thing for viewers or consumers out there is, you can go to a free seminar that costs $50 or something like that, and the chances are there's something being sold at the end of it.
Yeah. The larger seminar for $3,000.
Yeah.
For the weekend.
And so, but at least if they're actually paying reasonable money to go to something, there's a chance that there's less being sold, that they're actually paying for the advice.
Yes.
And again, to go to individuals such as ourselves, then obviously there's a price associated with that. So sometimes the cheaper the course is obviously the more you're being led down another path, whereas if you pay reasonable money or to professionals, then it's quite often should be better advice.
Well, the question is the leverage. The professionals have the experience, they've been doing it, they're doing it every day, and they will deliver to you. If you don't have time, they will deliver to you. The alternative is you spend the time. Now, do you have the time? And the question is, what would happen if you make a mistake? How much would it cost you then? But the professionals will deliver to you because they're doing it every day and they know what's in the market.
And a quick question a lot of people ask for various services, when you go to seminars, is that a deductible cost or is it not?
Chris, the initial basis of any expense to be deductible is it has to be matched against the revenue. So initially you have to have rental income coming in as a stream of income to match the expense against. Now, if you do have it and you do incur those expenses, then a proportion, most of those seminars cover a gambit of things, but mostly they cover how to buy property, how to create wealth through additional property and so forth. But only a proportion of that seminar will cover how to improve your rental returns, how to manage the agents, how to manage the trade professionals, how to manage everything to do with increasing your rent. That portion is allowed as a tax deduction against the rental income. And you can apportion that based on the number of topics or on the time that is spent in the seminar.
Sure. So if you're a first home buyer, you've never bought property, the chances are nothing will really be deductible.
Nothing is deductible.
But if you've already got properties, the proportion of the course that is improving those properties and getting you to get more revenue is more likely to be deductible.
It has to match against the
rest
revenue,
of its capital costs.
Yep.
So, but I guess the other question is from a wealth creation perspective, does it really matter if it's deductible or not? If they're teaching you to make money, who cares if it's tax deductible?
Well, that's exactly the point, Chris. If you're making money, that's just part of the cost of making that money. It's a business expense, it's irrelevant. And if you're learning something and it's good, you will multiply that with every transaction.
Yep, exactly. So personally, I don't care if things are deductible or not. If it's deductible, it's a bonus.
Yes, absolutely.
Right, Vito, let's jump into the hard figures straight away. We'll pull up the numbers on Sydney. Do you want to give us an idea of what's happening?
Sure. Well, over the last 12 months, the Sydney market has remained fairly resilient. This is different to the growth spurt that Sydney experienced between 2009 and 2010. The Sydney market last peaked in October 2010. If we separate the Sydney market into the top end, the bottom and the middle, the more affordable properties have risen by 0.7% year to date, while the top end has fallen 1.6%. Similarly, the bottom end has fallen 0.1%. We can see that houses are not as strong. Units are definitely performing much better or holding their value. So over the year, units are up 2.3% relative to houses, which are currently down 0.4%. And I really think that's an affordability issue. People, units there, you're looking at a median price of transaction of $340,000, but stepping up to $400,000 for a house in Sydney, well, you're going to have to, that's a different price level, cash flow is different, it becomes less affordable, so the unit market is really holding up the Sydney market, I think.
And to try and put some of those numbers in perspective, that say even if you take the house of dropping say 1.4% in a year, if you've got $1 million property, then that's basically dropped 14 grand. For $500,000 property, it's dropped 7,000. In the grand scheme of buying things, and maybe you bought it 5 or 10 years ago, a little bump like that, does 7,000 or 1.4% really make that much difference in a whole cycle of buying property effectively?
Well, I mean, it depends. Well, if I were to lose any amount of money, I wouldn't be happy with it personally. But these are through cycle returns. There are not necessarily people that are buying and selling property year in, year out. That is, they bought one house, held it for a year, and they sold it. It's not like equities. People are, on average, are holding property for about 6 years, and that actually can end up, you can stretch it out to 11 years. So there's differences. When we're talking about these numbers, we're talking about through the cycle returns, but through the cycle, people don't necessarily experience large falls.
Yep. So if you bought for 300, it's risen to 507, and it's bounced down to 500. Not necessarily the end of the world, but if you bought at 507 and it's now worth 500, you might be getting slightly worried. It's
not the case for the Sydney market, but there's definitely people in Perth that will have experiencing negative equity in their market.
Yeah, and through the course of the program, we'll get to all of the capital cities around Australia, so wherever you are, we'll give you some figures. Now, we'll be back in just a minute with Tip of the Week and more questions and ideas on property. Welcome back to the programme. Tonight we're joined by Dr. Vito Mollica from Rismark International and Shukri Barbara from Property Tax Specialists. If you've got a question about what's happening to our property markets around Australia or anything to do with accounting and tax for properties, then give us a call on 1300 30 34 35 or send us an email to property@skynews.com.au. And now it's time for our viewer tip of the week. And this tip comes from Phil. And Phil says, do your homework. A low price is not enough. You need a location that will continue to be solid no matter what happens in the economy. The income should cover all of your expenses, both fixed and variable, as well as your mortgage. It should also cover a reserve for unknowns, which is money you put aside now for repairs you know you're going to need at some point in the future, like a new roof or a strata special levy. Now, to get your tip on the show, simply email me at property@skynews.com.au, putting Chris Gray in the subject line. And all tips that we receive will get a copy of my book, The Effortless Empire. So please ensure you include your mailing address. Now, Shukri, on the tip, we're obviously talking about the income covering all the expenses. And for those that know Robert Kiyosaki, Rich Dad Poor Dad, that was very much his thought process, was that the income should pay it. But there is an argument, though, isn't there, that sometimes positive cash flow properties may not grow in capital growth, whereas the capital growth areas quite often don't have the income. So is there one rule that says one's right, one's wrong, or does it depend on personal circumstances?
No, it totally depends on personal circumstances. You've got different markets. Okay, the high value properties are usually growth properties, particularly if they're in front of water or the sea coast or you know, any attractive view. They will usually rise, and you can't get a lot of rent. People buy them partly because of emotion, and they're prepared to pay extra. But people who want to rent somewhere to live, they can't pay that much, a percentage equivalent. So the other properties where they're actually built for living and homes, you know, you can get more. They don't cost as much, and so your cash flow is important. They can cover most of your expenses. But frankly, in Sydney, I have not seen that where you can cover both interest as well as everything else, and particularly the growth properties will cover less than the cash flow properties.
Now, Vito, you brought a graph along that we'll actually put up on the screen about kind of capital cities versus the rural areas. We've got it on the screen now. Obviously, it's hard to read. Do you want to try and explain exactly what is on that graph?
So what we've got there is really highlights the importance of location. Is it better to buy in capital cities or in rest of state markets, i.e. not capital cities? So what we've got there, the blue line there shows the capital city performance since 2006, with the figures reporting year-on-year results, while the red line shows the rest of state. And we can see that at least from December 2006, prices in the rest of state market have fallen. And that's been generally the case. We can see that in 2007, rest of state market was up 10%, while the capital city market was up nearly almost 14%. During the GFC, the capital city market fell 2.5%, but the rest of state market actually fell even more. And subsequent to the GFC, we see that capital city prices really skyrocketed 12.7% relative to the rest of state, which only rose 7.6%. So we've got a big divergence there, and I really think, you know, First Home Buyers Grant highlighted that in the sense that people were buying in the capital cities because it's capital cities where you're going to get the growth.
Now, there's various reports in the paper, and there's various different companies that report on how much property has risen in various states around Australia. Can you explain to the viewers the difference between reporting based on median prices and hedonic, which is something that RP Data and Rismark do?
Sure. Well, there's three ways you can actually measure the performance of property in terms of an index. There's median prices, repeat sales, and hedonic indices. Median price indices are the simplest to calculate. All you do is you look at all the properties that sold in one period, you calculate the median price, which is the middle price, and you do it again the next period. So you've got two middle prices and you compare the two. That's not necessarily the best way to measure the growth in a market, because you're not necessarily comparing like for like. You might have properties in the first period that are all two-bedroom homes. The next period, the median price property that's sold is a three-bedroom home. So automatically you're just going to see an increase in property prices. But you're going to definitely have people that are going to say, I'm telling you that properties have not gone up. It's just a manifestation of the index construction methodology that's been used. So what repeat sales and hedonic indices try to do is detect the underlying growth that's attributed to the property market. So it controls for the fact that between periods, different areas are transacting, or different types of properties or different characteristics of properties are selling. So you can really understand what is the underlying growth to property, which is what we're interested in.
And this is where, say for instance, I read something in the paper recently, I think Tamarama, which is a beachside suburb near Bondi in New South Wales, they said it may have dropped 50% or something. But that could be just one type of reporting saying that, well, all of the houses were selling at 3 million, whereas we've suddenly got all these sales at 1.5, so maybe the median price has dropped by 50%. But you've got to read into it a lot more, don't you?
Tamarama is a very small pocket of the eastern suburbs, actually. There's not many houses there. And they are very different because you've got a few streets which cover the coast, and then you set back, and there's a dramatic price drop. So if you've got one period where all of those houses on the coast are selling, and then the next period the ones behind it are selling, you're going to see a fall. But it's not necessarily a fall for the people in the front because they haven't sold their properties.
And again, if you take it in reverse, you might get an area like Zetland that years ago was purely industrial, so there's no residential there at all, and then suddenly you get someone building for 500, then 6 and then 7, it suddenly appears as if the median price is going through the roof.
It's the reverse, exactly as you've said. You know, people in Zetland, you buy a studio, and then all of a sudden all the properties that are 2-3 bedroom units are being sold. You'll see a dramatic increase in price. But that's not the way you should be calculating property price performance.
And we'll pull up your second graph there, because obviously if people say, oh, Sydney rises by 5%, does that guarantee that every property that was in Sydney has gone up by 5%?
Definitely not. The property price indices that anybody quotes are just a measure, an indication, their general price performance. What's interesting to look at is what has been the buy-hold returns of people that have actually bought and sold a property. So this is what this chart does. It's a frequency chart of around 3.7 million repeat sale transactions. So that means there have been 7.4 million transactions since 1990, for which I can say, well, this person bought the property for X and sold it for Y. Let's calculate their annual compound returns and do a frequency chart of those returns. And you can see there that around 9.3% of people who sell their homes make a loss or get a zero return. Now, that some people might say, oh, that's a pretty conservative number. It actually gets even better if you see people that have actually realised a loss of -5. That drops off to about 2.3% of people. So you can see that the downside is actually very minimal in property,
so
reinforcing
you've got to be doing something seriously wrong to lose money.
Absolutely. I mean, the people that are coming out and saying that property prices are going to fall 40% or 20%, okay, you can have those forecasts if you want, and I don't know how much merit there is in them, but really, how many people are going to be impacted, i.e. how many people are going to realise a loss? And we've seen that historically from 1990, it's not that many. Whereas on the flip side, you've got 38% of people making returns of 10% per annum. So this reinforces the fact that the property market is stable and a good investment.
Yeah. So just to reiterate that, what we're trying to say there is if your property has gone from 507,000 to 500, fine, you've taken a loss, but if you hold on to it for another couple of years and it bounces up to 525, 550, it's almost irrelevant that it's dropped in value temporarily because you haven't sold it. And so literally only a couple of % of people are actually physically selling, and so they're not really realising those losses. Now we'll jump to a slightly different topic. Obviously, end of financial year last year, start of a new year now, people doing their tax returns. Shukri, what are some of the things that people should be looking out for in their tax returns at the moment?
Chris, there's a number of things right now. People who've bought or sold properties should look at their settlement sheets from their solicitors, and usually there are some adjustments for council rates, water rates and maintenance levies. They should also be taken up into their rental schedules to be allowed as a tax deduction. There's a number of other things which escapes me just at the moment, but we've got
Well, I mean, one thing I might just jump in
Sure.
to start with things like travel expenses. So when people are trying to choose properties,
yes.
a lot of them say, oh, I'll buy in Queensland, I get a free holiday every year, I go and see the sun. In reality, how much can you claim, and should you be buying an investment like that?
Yes, sorry for the mental block there, but of course, a lot of people, I mean, Queensland is a large market for investment properties, and when people want to go on holidays, let's say at Christmas or Easter or any of the school holidays, they decide, well, look, okay, what I'll do is I'll try to claim a deduction for the cost of the travel while I'm there. But in fact, the tax office doesn't allow that. What they do allow is for the cost of you, for the taxi fares from where you're holidaying to the particular unit or property that you've got investments in, and so you can't really get anything as much. You cannot claim the whole of the travel expense as a deduction.
And this is the classic thing of dinner party strategy. Investing isn't always necessarily the right thing. So no. I've still got properties in the UK. If I go back for 2 weeks to go and see my properties and see my family, yes. I can't really try and prove to the ATO that I've gone there to purely look at my property and then go back home.
No, I mean...
You can always try.
You can try. But look, literally, I mean, the ATO these days are extremely clever, as well as their new systems match everything to a T. And what they do is they also compare it to what the industry averages are. So if you do have a property, for example, in Queensland, you're living in Sydney, how long does it take you to actually inspect that property? 1 day. So they will look at the cost of a discounted fare with any of the discount airlines, plus 1 day's accommodation, and that's it.
So they don't assume you're in a private jet and you're going by Rolls Royce or anything like that. So
I don't think so, no.
It's not worth the risk.
No.
Now, another thing is I've recently been renovating a block of units. I bought in with 5 of my other clients to take control of a block. We've gone through council, we're rendering it, we're doing glass balconies. Yeah. The reason we're doing it is because the mortar between the bricks has literally been eroded with the salt from the sea air.
Yes.
And if we don't fix it, the building's going to fall down.
Yep.
So in my eyes and the eyes of a lot of my investing clients, they would say, surely that's a repair. We raised a 30 grand special levy. Can that be deducted, or is it a capital cost?
Chris, when you've got a special levy, you've always got to look at what is being applied to. Okay. Now, generally, even with the tax office, they're always struggling, clients are always struggling with whether an expenditure is actually a repair, for which you get a full deduction, or a renovation or an improvement, for which it is depreciated at the 2.5% annual rate. Now, my rule of thumb is, if it's stuck on the wall or on the floor, it's part of improvements. If it is being replaced, or fixing something that's already damaged, and the tax office uses an example which I like to use, it's quite good. If you have a window and you break the glass and you're going to replace the glass, that's a repair. But if you pull the whole frame out and you put a new one in, that's an improvement. And that's fairly similar with your example of concrete cancer and the likes. The fixing up concrete cancer doesn't just come overnight. It's a major issue to do with the maintenance of the building. It's a major part of the building, and therefore rendering it is a big job. You're using new materials, and it will be an improvement, in my opinion.
And so for our main reason for doing it, we're thinking of spending 30 grand a unit, and hopefully it will improve the building value by, say, 60,000 per unit. So it's very hard to argue that I haven't done it to improve the value of the building if I'm going to get a 60 grand valuation up.
Sure, and that's the value, and therefore it lends itself to being of a capital nature instead of you can have an argument, but then have you got the money to take on the ATO and go for a long exercise of dispute?
Yeah, so the golden rule there is you can't always have your cake and eat it, and if you want to take on the ATO, then they'll probably look at you every year, so it's not worth trying to push things. Now, next weekend there's a Property Expo happening in Sydney's Darling Harbour, and Property Expos are a great way to see what's happening in the property market and can also help you find your own team of professional advisors. There's mortgage brokers, accountants, quantity surveyors, valuers, developers, real estate agents, and of course buyers agents as well. Now, tickets are normally $18, but your Money, Your Call viewers can get in absolutely free. You can register on the website. Just go to homebuyershow.com.au/Sky and put Sky in the promotional code. Your tickets will come straight to your email address. Now, I'll be speaking from 2:30 to 3 on Friday and between 12 and 12:30 on Saturday and Sunday, and also giving away hundreds of copies of my book. So come along, say hello. I'll be around afterwards. We can have a coffee. Joining me on the panel of experts tonight, though, is Dr. Vito Mollica from Rismark International and Shukri Barbara from Property Tech Specialists. If you've got a question now, give us a call. The number to ring is 1300 30 34 35, or send us an email to property@skynews.com.au. We'll be back in just a minute. Welcome back to the the show. Joining us tonight is Dr. Vito Mollica from Rismark International and Shukri Barbara from Property Tax Specialists. If you've got a question about property and want their expert advice, number to give us a call is 1300 30 34 35. And now we'll jump straight to the figures on Melbourne and see what's happening there at the moment.
Well, the Melbourne residential market has softened. We've recorded 4 consecutive months of falls. It's currently down 3.2%. We can see that houses are down for the month of 0.3%, and year on year they're down 2.3%. The actual residential market for houses in the Melbourne market is returning the worst yield of all the capital cities with a return of 3.7%. The unit market in Melbourne is actually going through a boom in terms of building. You've got the CBD, South Bank, Docklands, Port Melbourne and Richmond and South Yarra area. There's been just an influx of properties coming onto the market, and I think there's going to be a case of oversupply. And that's why I think the unit market will not necessarily hold up so much, and that's why you can see there that year to date it's down 3.4%.
But so that's interesting there, because I'd always seen in the figures before that Melbourne had gone down, but actually for the month that it had risen. Is that because of new stock coming on, or? Well,
the units, that 1.6% their increase for units, we actually think that will revise come next period, because we have experienced a small number of trades in Melbourne. Melbourne trades are actually back to their 2004 levels, so there are not a large amount of volume coming through, and it highlights again that there is some weakness in that market.
And I guess that just reconfirms that when you're looking at figures, to look at it daily or weekly or monthly, you can't really draw too many conclusions. You really do need to try and look at a longer period as possible.
Absolutely. I mean, I try and marry up. One of the things I teach you in finance is you marry up your investment returns with the horizon you're looking at. If you want to buy property for 1 month, I actually don't think you can buy and sell a property within 1 month. You need to look at what is year-on-year returns over the long run. And I think that is a better measure of what is the expected property price performance.
Yep. And let's have a jump to Brisbane and see what's happening there.
Again, Brisbane market is quite weak. In terms of number of sales, they're back down to their 15-year levels, well, their levels 15 years ago, their lowest. The confidence in the market is very, very low, and that's across all of the market segments. We can see there for houses, for the month, they're down 0.5%, but year on year, 6.3%. That's a very big fall. And similarly, units are falling 6.3%. And this really excludes Gold Coast, which has been hit by at least falls of 10%.
So talk to me very briefly about the floods and how you think that affects the figures, and also mention the Gold Coast, because that always does get mentioned, and how that affects the figures.
Sure. Well, the floods, we saw the pictures and they were quite devastating. But speaking to valuers, we found that the number of properties that have been impacted and actually sold is very, very small relative to the rest of the market. So people who are suggesting that the Brisbane market is all down because of these floods, I don't actually think that is the case. The Brisbane market has always been unique in that it has been the most lacking in consumer confidence. People in Brisbane can actually, there's different laws. You can get out of a property transaction quite easily. In New South Wales we have a cooling off period of only 5 days, but in Brisbane that cooling off period basically exists until settlement. So you get a lot of sales that don't eventuate. So that pessimism always is there. Whether I think the Gold Coast will recover, I'm not so sure right now. We've actually seen a lot of developers stop building. They said we don't think that the market is ready. A lot of people are treating Brisbane and Gold Coast similarly. It's been almost amalgamated into the capital city, but there is just an extreme amount of volatility of recent past. That's sort of calmed down now, but prices don't look like they're going up.
And is that because it's more like a one industry town, that it's so reliant on tourism there?
The tourism, and also who the properties are directed to. A lot of those properties are directed to overseas investors, and those overseas investors are seeing Australian property as expensive, not from the perspective that prices are high, but exchange rates. They're not going to get their bang for their dollar, what they might have gotten 3 or 4 years ago.
Yeah. Now, while we're talking about overseas market and overseas investors, there's a lot of people that are talking about US property over the last few years, obviously with all the pain that's been over there. We'll pull up a graphic. Can you take us through, Shukri, some of the reasons why people would buy in the US, and then obviously maybe some of the risks?
Yep. Chris, the driver at the moment, and certainly from the clients that I'm seeing, has been the very high dollar. The very high dollar. Firstly, the GFC and the massive mess that they've made over there has dropped values quite dramatically. When you couple that with a high dollar, that means you can get into the US market quite painlessly. Not that I'm technically endorsing that in any way, but you've got to be really careful because there's a lot of factors that dictate the market. But the Australian dollar is making it attractive so that, you know, the cash return that I'm seeing, I'm getting a lot of emails from promoters that's saying, look, your net yields range between 15 and 25% in cash terms. Now that's very good. If you're buying a property for about $20,000 and you buy 5 of those and you're getting 15 to 25%, that's fabulous, especially like some of my clients have done, buying it in the super fund with no borrowing. And so if you don't have to borrow, now look at the advantages. Should at some point that has to correct in America, and if it corrects and capital values go up, well, you're certainly a winner. If the dollar, as a result, also the American dollar goes up against the Australian, with the Australian going down, you're also in front. Of course, there are risks there, but that's where people are looking at. Overall, it's very advantageous. You've got all those things. The entry level is low, the exchange rate is in your favour, and you've got a low entry price. Very attractive, but is it worth it?
And that's the big question, because wherever there's positives, there's always got to be a balance of negatives.
There's always a risk.
What do you see as the main risks?
Well, look, some of the risks are already involved. I don't know the whole lot of them, and that's why we've asked a US lawyer, a senior US lawyer, to come onto a seminar that we're putting on the 10th of August. So if anybody would like to come to that, he will be talking about some of the risks and some of the structures that you need, because as we know, the US market is very litigious, and you don't want the tenant to be suing you and affecting you here in Australia from a problem down there, and their market is completely different. So we've also asked someone who is Australian, who has already done that exercise and invested there and is helping other people doing that, to explain what the market is like.
And look, it's obviously the education part is very, very important. Extremely. And to be getting the advice from accountants as well. So if people want to get this information, where can they find the details on the seminar? They
can go to our website, www.propertytaxspecialist.com.au, or email us directly from the website, and we're happy to do that. But there is a link directly into the booking fee.
Great. And when it comes to whether they're investing in the US or they're investing in any other country, and it's almost like interstate, because sometimes it can feel that you've got that lack of knowledge. What is the risk of investing in foreign markets or in state markets that you don't really understand? How high does the risk suddenly jump up?
The risk is very high. Firstly, because you don't know who's dealing with your money down the other end. Okay, the psychology of the Americans, as I have read in some of the emails for people who have been there, it is quite different. The art of the deal over there is not quite like Australia. Australia, you're working on the basis of what is fair. Over there, what you agree on is what has to be delivered. Even though you didn't understand it, you will come back facing that, and it's extremely dangerous.
Now, I do quite a lot of talking in Asia, specifically in Hong Kong. And a lot of people were buying Australian properties and they were buying in Hong Kong because obviously the interest rates were so low, but they suddenly got stuck. With exchange rates bouncing around so much, should the golden rule be if you buy in a certain currency, you should borrow in that currency, or should you be taking the currency risk at the same time?
Chris, that's a vested question. That's a very difficult question to answer.
That's why I'm asking you.
Yes, yes, I understand. There is no straight black and white answer to that. In the existing situation where you've got the Australian dollar extremely high relative to the American dollar, then you're better off going in from here. But really, if you don't borrow at all, as I was suggesting with some of my clients using their superannuation money, then you don't have that risk at all. Okay. However, your exchange risk increases because you don't know when the problems in the US are going to be solved. It doesn't look like anywhere near, so you're hoping you will get a benefit out of that, just on the face of it. But there is no guarantees to that. The market's risky.
Because it's very appealing, and I've still got borrowings in the UK, and if you're borrowing at a couple of percent, it's absolutely great. But if the currency swings 20 or 30%, then suddenly $1 million mortgage can become 1.3, and that's it's hard for capital growth of properties to beat that.
But the advantage is, of course, your properties in the US are very low value, and of course the difference is, and as I understand it, it's very difficult to get any finance in the US from traditional lenders.
And that's probably not a bad thing, is because it is reasonably cheap to invest over there, is if you're going to go and invest in something else, don't go and throw millions at it.
No.
Dip a toe in the water and take it slowly.
Exactly. Your rate of return is high, which will absorb some of that risk, and at the same time, your entry level is very low.
Okay, let's go back to some numbers again. Let's have a look at Perth and see what's happening over there.
Well, Perth is in the midst of a property price correction. It's actually the second worst performing city relative to Brisbane. Volumes are also down. We're only transacting about 35,000 sales a year. We're in the boom times. You know, Perth was transacting 60,000 property sales a year. For the month, we see that houses are down 0.4%, and similarly for units. Year on year, the house marking is down 5.5%, while the unit is down 1.1%. On the flip side, though, your rental yield is not too bad. You're getting 4% for houses and 4.7% for units.
And certainly in terms of affordability there, so the numbers at the top, 400 grand median price for houses and 340,000 for units. For a lot of people that are in Sydney and Melbourne, certainly it's hard to spend 500, 600, 700,000, especially with deposits. At least it's affordable, isn't it?
Absolutely. I mean, I know of certain individuals that basically use that exact argument. And there's also other benefits, you know, in terms of taxes. You're facing different stamp duties in each and every different state. But you need to know which price bracket you want to be in. I mean, that's just the median price. If you're looking at areas such as Peppermint Grove or the inner city or Burnswood, where you've got the top end properties, they're actually down quite a bit. And they're very volatile and they're expensive, if not more expensive than Sydney. So you just need to pick which segment of the market you're interested in. Make sure you do your research and know how it is performing.
And then on our tour around the country, let's jump to Adelaide.
Sure. Adelaide is a very homogeneous area. Basically, you know, you can break it up into 4 parts and they're all performing the same. There's a downturn there as well. Currently prices are down around 3% year to date, and prices are just flatlining. You can see houses there down 2.7% for the year, and units are down 4.5% with yields of 4.2 and 4.7. Adelaide used to be a real success story because it was so cheap. People were buying properties there and getting good returns. That success story seems to have shined off a little bit, and I think that's also got to do with the overseas market not being interested so much in the Adelaide market because of those reasons. Affordability, exchange rates were good, and also university students. Now the price or the relative price benefit or cost of living of Adelaide, it doesn't exist there, I think, for overseas investors.
Sure, so certainly a mixed bag around Australia. Now, we're going to take a short break. We'll be back in just a minute, so don't go away. Welcome back to the show. The experts are here to answer your questions about what's happening in the property market. Give us a call on 1300 30 34 35. Now, it's obviously tax time at the moment. A lot of people are also looking at buying properties, and so this is where you need to worry about who's actually going to own the property. So, Shukri, when it comes to owning property, some people will choose to do it with partners 50-50. Sometimes they have 99-1 and 1-99. What's the right answer, or what do you need to worry about at the moment?
Chris, what you've really got to do is you've got to start planning. Planning before you make those decisions to buy. That's very important. If, for example, your husband and wife, you're planning for a family, you're expecting the partner who's going to look after the children to stay home, then you would want some of the benefits of the negative gearing to be offset against your other salary, and so saving you some cash and saving you some tax as well. So if you're doing that and you foresee that for the next 5, 6, 7 years, and you're starting off on your first or second property, then your first property usually, from my experience in my practice, you find husband and wives usually buy a 150-50 the first property. When they come to the second property, the first child is already there and they're planning for the second and third child, and there's not likelihood for the partner with who's going to look after the children of earning any income. So it will be best to go 99 to 1%, and the 1% or 2% is simply to give comfort to the other spouse so that the property can be dealt with without their say-so. But most of the tax deduction will go against the person with the salary.
Right, okay. All sounds good advice. We've put the phones back on the hook now so the calls can come through. We've got Vince from Canberra on the phone. Welcome, Vince.
Good day, Chris.
How are you?
Good, thanks.
Good. What's your question?
My question is in regards to title insurance and whether you think it's necessary to get title insurance.
Yeah, sure. Now, it's something that we covered on the show, I think, about 3 or 4 weeks ago. And in all honesty, I'd never even heard of it before. And so that's why I thought I'd obviously put it on the show and have a discussion about it. Look, from what I've been hearing from various people is a lot of people think that, look, it is an additional cost. There's plenty of additional costs with property. And so do you really need to go that far? And so it's a lot of things that, a lot of expense that a lot of people wouldn't do. But there's always these horror stories of something suddenly does go bad and suddenly whatever the solicitor's done, then it's not covered. And so, look, to give you the best answer would be to say, look, insurance, you should always take it out if possible. But at the same time, I realise that the reality is that you can't always do it. So it's a bit tough. What I'd probably do is actually probably speak to your solicitor about it and just double check with them. And it may be different from state to state as well, to see what's going to be around in your kind of area. So, look, it's still new to me, and I think because we've had quite a few questions, we'll probably bring it back on again. So, thanks for the question there. Now we've got John from Sylvania Waters. Welcome, John.
Yeah, thanks, Chris. Thanks for having me here. Thanks for taking the call.
Pleasure. What's your question?
I'm a conservative investor and looking to invest in capital cities. I just want to ask the panel, if they had to invest in a capital city without locating any suburbs, which city would you be looking at given the results that have come through?
Sure. No, good question. I think that's to you, Vito. So, any amount of money, any capital city, which one would you choose?
I'd pick Sydney. Several reasons. I know that market, but I actually do think that it is a market that has not performed as well over the recent last couple of years. It has underperformed Australia relative to the other capital cities. Most of the boom has been through the Darwins, the Perths and the Queensland. They're coming off now. Sydney has always been a stable market and it will go through a growth spurt again. I think the fundamentals for the Sydney market are strong. It's a strong services-based industry. Australia will move to much more to a services-based industry because this, mining boom, it's only going to last a certain amount of time. We're going to dig up all this coal. People are going to have to do something else, and services are going to be the future, I think, of Australia.
Now, when you're picking a state to invest in, and you're trying to make that decision, roughly what time frame are you thinking of? Are you thinking, look, Sydney's going to be the best performer for the next year, the next 3 years, 5 years, 10 years, or just generally forever, Sydney's always going to be better? Or are you just saying, no, right at this minute in time, I'll pick Sydney?
I picked Sydney right now for the long term, but I also do believe that for the next 3 to 5 years. I like to think in 3 to 5 year terms because that is the time when you can get into trouble with your mortgage. Okay, most people don't get into trouble with their mortgage after that time period. So if you think you're going to buy a property that you can at least service for 5 years, you will realise capital gains after 5 years. Year on year for 3 year buy hold returns, Australia has never seen negative property price returns. So we can see there, 3 years, you should be okay. 5 years, I think be conservative, know you'll be able to service the debt, you'll be ahead.
Yeah, thanks for the question there, John. Obviously very interesting, and it's good to know what the experts themselves will invest in, because they're the ones with all the numbers, and they're the ones that can tell us ideally what's happening. Now, there's obviously a lot of renovation shows kind of happening at the moment, and renovations are always been reasonably popular in Australia. From a tax perspective, Shukri, what are some of the things to be aware of, and is a good thing to be doing at the moment?
It's always good to be doing renovations. A lot of my clients do that. The question is always going to be, from a tax perspective, what is your intention with acquiring that property? The key is going to be this. Are you going to be taxed on the gain? Firstly, are you going to make a gain? Are you going to actually realise the gain by selling the property or not? So intention, as far as the tax office is concerned, is very important. If your intention is to buy, renovate and sell the property, then you're actually in the business of renovation, and the profit is going to be taxed normally as a business profit. If you're intending to buy the property, renovate it and improve the opportunity for higher rent, then that is a capital growth. Then the cost of renovation adds to the cost base of the property, and later on, should you sell it after 12 months, let's say, then your capital gains are a bit lower. Okay? The issues are always, intention is very important, even if you held the property for longer than 12 months. If it's clear to the tax office that you're really doing it to buy and sell, then you may be in trouble. But that's been rare in my experience. Usually people buy it, renovate it, improve the rent, hold on to it for a number of years. Their circumstances change, and that's what really forces the sale. So if that's your position, then I think it will be capital gains subject to the 50% discount should you be selling it overall. So the question is going to be now, how are you going to increase? Do you get a quantity surveyor's report to get the valuation of the cost, or do you just add it? Well, quantity surveyor's report is always good because sometimes they cover most of the things, and it also assumes that you haven't kept all your records, which is quite good. The other issues are whether GST is involved. Of course, if you're going to be selling the property, if you're buying and reselling, so you're carrying on a business, then GST will be there. If your renovation is considered, to what the tax office says, substantial, that means knocking walls and so forth, and it's considered to be a new property, then you might be selling a new property, GST will be payable.
And that's obviously going to be a major cost. Major
renovation, yes, major cost, because when you're selling to the market's not factoring that in, it's just factoring a price. So if you fall within that, you have to take some of that money out, but you will get a credit from the cost, from the GST you pay on the materials and services that you get to build up.
So that's good. Again, obviously the advice is get the advice from the accountant before you start doing it. So just before the end of the show, we'll jump to Darwin and try and get Canberra in as well to see what's happening there.
Sure. So Darwin's provided great returns historically. That seems not to be the case this year with prices falling. The good story about Darwin, though, is that it is offering the best rental returns for investors. Rental return on houses is currently 5.2% or 5.6% for units. So buying a house in Darwin or a unit, you can expect some good cash flow. The capital returns are not there right now, but they will come, I think.
And I think for some of the last slides, the median prices that we've put at the top, I think it might have been my typing, they haven't updated, so probably don't rely too much on those for these particular slides, but certainly the percentage rates are fine. Let's jump to Canberra as well and see what's happening there.
Canberra is the other darling story, I guess, of this not so good year, along with Sydney. The Canberra market is a safe place to invest because, well, a lot of the population there is tied to employment with government. So you've got people that have got stable jobs for long periods of time and obviously able to service their debts. You're not going to have a lot of properties coming into the market which are mortgagee in repossession. So that's why we always see the Canberra market performing pretty well. Year on year, houses are down, but the unit market is very, very strong with 3.3% up. The yields are also quite good, offering 5% for houses and 5.4% for units. So I think the cash flow story there is quite good for Canberra for somebody wanting to invest.
And just as a final message from the expert with the numbers, have you got a smile on your face when you're looking at the property market at the moment? Do you think things are reasonably positive out there in the short to medium term?
I really will have a better answer on that question on Tuesday when the Reserve Bank meets. I don't think we're going to have a big reversal in returns. You know, Tuesday's a big day in terms of RBA. Also, we're going to see what's happening with the US debt. There's a lot of unknowns, and I think that is my short-term view. I'm very uncertain as to what the property market is going to do.
That sounds like an honest opinion. Dr. Vito Mullica from Rismark International and Shukri Barbara from Property Tax Specialist, thank you very much for joining us. And thanks to the viewers at home again for joining us and those that have rung in with their questions. Now, next weekend, there's the Property Expo happening in Sydney Starling Harbour. Tickets normally $18, but Your Money, Your Call viewers get it absolutely free. homebuyershow.com.au/Sky and put Sky in the promotional code. I'll be speaking from 2:30 till 3 on Friday and from 12 to 12:30 on Saturday and Sunday, and giving away plenty of books as well. So come along and say hello. I look forward to seeing you again next time. Until then, I'm Chris Gray. Good night.